Interested in finding an additional income source? Do you want your cash to do more than just invest in dividend stocks? This video, I'm going to be breaking down how I make monthly passive income from selling cash secured puts. In my next video, I'll show you how I make monthly passive income from selling covered calls. I'm going to include a link to my Google spreadsheet. I've been tracking every option trade I've made since April 2020. I've been trying to include as much detail and information as I can so you can follow along. You can see what's working and what isn't. I show you the date I sold the options, what strike, how many options, what expiration, etc., etc. In this video, I'll cover a few topics, including why options are better than dividends, what is a put option, how much money do I need, how do I pick a stock, how do I pick an option to sell, what is my max income, what is my max loss, do I have to manage it, and how to paper trade options. I know it sounds like a lot, but at the end of the video, I'll head to my computer and show you how much money I've been making off of cash secured puts and examples of what it looks like when it goes right and when it goes wrong. For anyone interested, I do have a live trading series where I do live option trades on Questrade every week if you're interested. Getting to my first topic, why I think selling cash secured puts are better than dividends. My answer, and probably the best answer, is I feel I can make more selling cash secured puts, selling options, than I can by holding a stock and earning dividends. If you're holding a Canadian bank stock, you're probably earning 5% annual yield. If you're holding a REIT, you're probably making 7% in dividends per year. Or let's say you're just invested in the S&P 500, which has had annual returns of 9.8%. I still feel I can beat that by selling put options. I believe you can make 1% per month if you're safe, and 1.5 to 2% per month if you take a little more risk. Regardless, as long as you're making at least 10% per year, you're indirectly beating the market. Selling options, in this case selling cash secured puts, you can make money if the market goes sideways, if the market goes up, or if it decreases slightly. The way I sell put options, and I'll show you how, I'll show you what I do, the odds are heavily in my favor. Now the important part, what is a put option? A put option is a contract that gives the buyer the option, but not the obligation, to sell 100 shares at a predetermined price and a predetermined date. The buyer pays a premium to buy a contract. The premium is paid to us. So this is us, this is what we're doing, we're the sellers. We're earning that premium. The seller can be forced to buy shares from the buyer if the contract goes the wrong way, and I'll explain why a little later. This is why ideally it's called a cash secured put. The ideal scenario, the seller would have the cash to fulfill their obligation. Why would anyone buy a put option though? Why would I pay someone to have the right to sell them shares at a later date? Well, let's say I bought 100 shares of Apple at $125 per share. I'm afraid in the next 2 months, maybe after their earnings date, the shares might drop, and I'm afraid it would drop. I'm afraid of having that loss. So I buy a 60-day put option at $125. That means if Apple goes to 100, I have a contract that says I can force someone to buy it off of me for $125. Apple went down $25, but I didn't lose anything because I can force someone to buy it off of me at $125. I'm basically buying insurance. I'm buying insurance against the stock from going down. As soon as someone buys an option, let's say they pay $100 for that option, that money is gone forever. No matter what happens after with the stock price, that money is gone. You already bought this insurance. Conversely, on the selling side, if you sell an option, you earned a premium. You earn that $100. No matter what happens to the stock after, let's say Apple stock, if it goes to 1,000 or it goes to 0, that $100 I made is mine. It is mine forever, no matter what happens to the stock after. How much money do I need? I'm going to be keeping it very simple and only talk about cash secured puts instead of trading on margin. Obviously, if you trade on margin, you can greatly increase your return, but it obviously comes with a little more risk. So just talking about cash secured puts, the amount of money you will need is enough to buy 100 shares of the stock you're trading. If you're selling options on Apple and it's trading at $125, you'll need 100 times 125, you'll need $12,500 US set aside. If you're trading options on Air Canada and it's $25 per share, you'll need 2,500 Canadian dollars set aside. How do I pick a stock to sell a put option on? I'm going to keep this very simple. Please learn from my mistakes. Only sell put options on shares that you wouldn't mind owning in the first place. Worst case scenario is someone forces you to buy 100 shares. So don't do what I do, learn from my mistakes, only sell put options on shares that you'll buy anyway. How do I pick an option to sell? There are many ways, there's no one best way to do it, but I'll give my recommendation. I like to sell options that are 30 days minimum and 60 days maximum to expiration. If you sell a 30-day option, hopefully in 30 days it expires above your strike price. That means they're worthless. No one can force you to do anything. The contract isn't worth anything anymore, so you can turn around and sell another option again for 30 days out. This is how I make monthly income. This is why I said it's like monthly passive income. I usually sell 30-day options. Ideal scenario, like let's say 85% of the time they expire out of the money, they end up expiring worthless, and I can repeat the same process over and over again every 30 days. You can sell 60-day options if you want, but keep in mind you won't be earning that much more. When you're selling options, you're basically selling time. You're selling the buyer time to be right. So if you make $100 selling a 30-day option, you might only make $180 selling a 60-day option. So the law of diminishing returns applies here. When it comes to choosing a strike price, you can use the charts. Looking at this chart of AMD, you can see the stock kind of bounces off the $72.50 share price. I would use this as a base. So let's say I see this, I say, okay, I wouldn't mind holding AMD at $72.50. Let me sell a 30-day option at the $72.50 strike. Let's see how much I make off of that. Looking at this option chain, the right side is the put side. So looking at the $72.50 strike for 25-ish days away, I can sell that option for $1.16 per share or $116 per contract. Remember, every contract is 100 shares, so you'll have to multiply everything you see by 100. Another way to choose the strike is by using the delta. This can be described as the probability of your option going in the money. So if you sell an option at the 0.3 delta, there's a 30% chance it will drop below this. Conversely, this means there's a 70% chance, 0.7, that it won't drop below this. By using the 30 delta, you're choosing an option with the 70% probability. So I would recommend choosing 30 to 60 days to expiration and 25 to 30 delta. What is my max income? This one is pretty simple. It's predetermined. It's the amount you earned by selling the option in the first place. Looking at the option chain for AMD, look at all the prices under the put section. Those are your max amounts, the maximum amount you can earn. If we sold the $72.50 strike for the June 18th expiration date, I would earn $116. That is my max income. I cannot earn more than that. If we choose a long expiration, I'm filming this in mid-May, so if we sell in July around 60 days out, I'm earning $221 per contract for that same strike. So I'm earning more money because I'm selling more time, but I'm not earning twice as much even though I'm selling twice as much time. What is my max loss? Remember, this is a neutral to bullish strategy. So if the market trades sideways, you'll make money because obviously for it to go in the money, the stock would need to drop in order for someone to be able to force you to buy the shares. If the stock goes up, you'll also make money. Again, the buyer would need the stock to drop in order to force you to buy the shares. If the market tanks, however, your max loss is the entire collateral or cash you set aside to secure that put. Remember, it's called cash secured puts. So that cash you have set aside, that is your max loss. If you sell an Apple contract for 125 strike, that means you put aside $12,500. If Apple goes to zero, that is your max loss, the entire $12,500. That's why everyone says, that's why I say, never sell put options on shares you wouldn't mind owning, because hopefully if you do it on Apple, Apple won't go to zero. If you sell an option on Air Canada at the 20 strike, you'd only need to put up $2,000. Your max loss is that $2,000. If Air Canada goes to zero, hopefully not, that is your max loss, the $2,000. Do I sell a put option and forget about it, or do I have to actively monitor and manage it? The short answer is yes, you have to actively monitor and manage it, but only if the stock tanks and goes against you. Here's something I didn't mention before. Selling a put option means someone can force you to buy 100 shares at a certain price at a certain date, but you don't have to have that contract open forever. No one can force you to keep that obligation open. You can buy back that option that you sold. So let's say you sold a car to someone and there's something wrong with it, you always have the option to buy it back. Not in real life, but in terms of options, you always have the option, to buy that contract back to eliminate your obligation. You can close your initial position. Granted, the price you'll buy it back at, the price you'll pay to close your obligation will be different than the price you sold it for. So you will either be at a gain or at a loss, which I will show you on my Questrade account. My advice is always close your obligation, always buy the option back. Whether you're making money or losing money, I don't like to be forced to own the shares because it hasn't worked out for me in the past. I only like to trade on options. I don't want to end up owning the shares, even though I know the possibility someone can force me to own the shares. Just my advice, close it early, buy back your position, and sell another one 30 days out or 60 days out if you want. Remember that you don't have to keep that obligation open, even though you have the cash set aside to buy the 100 shares. My advice, I know I'm repeating myself, buy the option back, close it out, and sell a new one 30, 60 days out, hopefully for a gain. I will show you examples of that a little later on. How do I paper trade options if I'm not ready to dive in fully? I recommend using barchart.com and select option prices to see all the available option prices and expiration dates. You can choose any option chain to play around with if you want. If you want to look at charts to see the way a stock is trending, I would use tradingview.com. These are both free websites. If you want me to pick a stock for you just so you can play around, let's say you don't know where to start, let's choose AMD. I've been selling puts on AMD for over a year and I've made over 12,000 US dollars. I will sell the 7250 for June 18th and July 16th. Just check back to see those same options in the bar chart to see how they're performing and if you have to manage it. Now the final part, I'm gonna head over to my computer, show you my Questrade account of, let's say I'll pick two examples of selling put options, when it works and when it doesn't. All right, hopefully you've made it this far. I will show you my income right now. Let's say I've been monitoring every single stock and every single trade I've been making. Let me zoom in a little. So looking for April, my cash secured put strategy earned me $3,127. Obviously, I have, some negatives here and some other strategies, but if we're just looking at cash secured puts, $3,000. If we look at March, I made $1,609. Things weren't going so well for me in March. Things tanked, no big deal. If we look at February, I made $5,705. Very well, I was very happy here. Took a little more risk. January, $11,277. This is an outlier. Don't trust this number going forward. I took too much risk. It paid off in January, didn't pay off in March. Let's go to December. Good month, $6,680. So you can see I've been making not consistent money because it varies, but consistently I've been making money. You don't see a lot of negatives. If you do want to see an example of negative, is May. So far, I'm not doing well. I'm down $1,600, but this is my fault. I took risks I shouldn't have, and I'll show you right now. So if we go to Questrade, if we look at AMD, remember I said I've been selling puts on AMD for a year and I've been making money. Let's take a look at how to read this. Right now it is May 24th. I sold the June 18th option for the 6250 strike. So that means if AMD drops below 6250, I can be forced to buy 100 shares. But look over here, I sold 8 of these. Okay, so I sold a lot. I do have a big portfolio. So if you sell one contract, you'll need 6250 times 100, $6,250. But I sold 8 contracts. That means my entire obligation for this one I sold is 50,000 US dollars. But take a look. I sold this at 62 cents a contract, 62 cents a share. Remember I said multiply this by 100, so I made $62. What is my return? I'm putting up 62.50, I'm earning 62, so this is a little less than 1% per month. So $62 by 6,250, it is 0.992 for 30 days. But take a look, days to expiration, I still have 25 days left. So what does this mean? Can I just stare at it? Am I just gonna let it sit here? What do I do? This is an example of the stock working in my favor. Right now, the price to buy this back is $12. So 12 cents per share, $12 a contract. Open P&L, so I'm up $400 on this. I only sold this last week. So within 5 business days or 7 days total, I made 75% of my entire contract. Remember I said close this early? Because I made majority of my money already within 5 days, why wouldn't I close this out? What this tells me is I have 25 days to go wrong. Like earnings can come out, AMD can tank, and I can be at a loss. I can be forced to buy $50,000 worth of shares. So since I have 25 days left, I am gonna close this. So instead of making 8 times 62, my total income could have been $496 if this expires at the end of 25 days. But I'm making $400 with only 10% of the time. So I am gonna close this out. This is an example of a trade going my way. I will show you an example of trades not going my way. If we choose, I believe, Riot, take a look at this. Let's read it the same way. I sold the June 18th expiration. Today is May 24th. The 27 put. I sold it for $4.55 per share, $455 a contract. But then we look over here. If I was to buy this back, I'd have to pay $545 for it. This is an example of a put option not going my way. I'm at a loss right now because I sold 10 of these. Instead of $2,700 being my obligation, I sold 10. My obligation is $27,000. This is an example of it going against you. I will show you now why I don't like getting assigned on the shares. Remember when I said buy it back early and continue selling out 30, 60 days? I don't like accepting the shares anymore. And remember, I said don't sell options on shares or companies you wouldn't mind owning in the first place. Look at this horrible example. If people say this is a no-lose strategy, they're lying, they're deceiving. Look at this loss. I'm at a $12,500 US dollar loss. I've been selling puts on Workhorse for months. It was trading at $20. I wanted to own it at $20. It went up to 25, 35, 40, and I was continually selling around the 20 strike. And then they ended up losing a contract, the USPS contract. Their shares tanked 75%. They dropped so much, I ended up owning shares. Someone forced me to buy 1,000 shares at $20, $20.80. Look at what it's worth right now. These shares are worth $8.33. So this is an example of why I say don't buy the shares, just continue rolling, continue selling. This was my mistake. The stock dropped so much, I'm at a giant loss, $12,500. I am gonna hold this because I'm stubborn. Hopefully the company comes back. If not, we'll worry about that later. I will show you in my next video how I make monthly income selling covered calls. This is where Workhorse comes into play. But obviously sell on good companies, AMD. Don't sell on new bad meme stocks like Workhorse. This is my mistake. I think that's it for this video. I'm not going to show you how to trade yet. If you do want to see my trading videos, they are on my channel. I do have a playlist called Live Trading Series. There's around 45 videos there. I think I'm going to end it here. Let me know if you have any questions or concerns, or if I said anything wrong. Ask any questions you have. I really want to help people. A lot of people have been asking me how to make additional income sources. This is one of my favorite ways. I know it's a little more advanced, but once you get into it, once you paper trade a little, or just dabble in it with a cheap stock like Air Canada, it's only $25 a share, so you only need to put up $2,500. That's all for now. Tune into my next video on selling covered calls for monthly income. Thanks, guys.